How to invest in stock basics for beginners introduction. Investing in the stock market can be a daunting task for beginners. The idea of putting your hard-earned money into something as volatile and unpredictable as the stock market can be intimidating. However, with the right knowledge and approach, investing in stocks can be a rewarding and profitable experience. In this guide, we will cover the basics of how to invest in stocks for beginners. We will discuss the benefits of investing in stocks, different types of stocks, how to choose a stockbroker, how to create a stock portfolio, and the different strategies you can use to invest in stocks. Benefits of investing in stocks. Before we dive into the nitty-gritty of investing in stocks, let's discuss some of the benefits of investing in the stock market. 1. Potential for high returns. One of the biggest advantages of investing in stocks is the potential for high returns. Historically, the stock market has provided an average annual return of around 10%. While past performance does not guarantee future results, this long-term average suggests that investing in stocks has the potential to provide strong returns. 2. Diversification. Investing in stocks allows you to diversify your portfolio. By investing in a variety of stocks from different sectors and industries, you can spread your risk and reduce the impact of any one stock or sector performing poorly. 3. Ownership. When you buy a stock, you become a partial owner of the company. This means that you have a say in the company's decision-making processes and can potentially benefit from the company's success through dividends and share price appreciation. 4. Liquidity. Stocks are highly liquid investments, meaning you can easily buy and sell them as needed. This provides investors with flexibility and the ability to react quickly to changing market conditions. 5. Accessibility. Investing in stocks has become increasingly accessible thanks to the proliferation of online brokerage platforms. This means that anyone can invest in stocks, regardless of their financial situation or location. Types of stocks. Before you start investing in stocks, it's important to understand the different types of stocks that are available. 1. Common stocks. Common stocks are the most common type of stock. When you buy a common stock, you are buying a share of ownership in the company. Common stockholders have the right to vote on company issues and elect the company's board of directors. They also have the potential to receive dividends if the company decides to distribute them. 2. Preferred stocks. Preferred stocks are a type of stock that typically pay a fixed dividend. Preferred stockholders do not have voting rights but are given priority over common stockholders when it comes to receiving dividends. 3. Blue chip stocks. Blue chip stocks are shares of large, established companies with a history of stable earnings and a strong financial position. These companies are typically leaders in their respective industries and are considered to be among the most reliable and stable stocks. 4. Growth stocks. Growth stocks are shares of companies that are expected to grow at a faster rate than the overall market. These companies typically reinvest their earnings back into the business rather than paying dividends. 5. Value stocks. Value stocks are shares of companies that are currently undervalued by the market. These companies are often established businesses that have fallen out of favor with investors due to short-term challenges. Understand the stock market. 1. Before you start investing in stocks, it's important to understand the basics of the stock market. The stock market is a place where stocks, bonds, and other securities are bought and sold. The stock market is a complex system that is influenced by many factors, including the economy, global events, and company news. 2. Stocks are shares of ownership in a company. When you buy a stock, you become a part owner of that company. The value of a stock is determined by the performance of the company and the demand for its shares. If the company performs well, the value of its stock will likely increase. If the company performs poorly, the value of its stock may decrease. Develop an investment strategy. 3. Before you start investing in stocks, you need to develop an investment strategy. An investment strategy is a plan that outlines your goals, risk tolerance, and investment approach. There are many different investment strategies to choose from, including value investing, growth investing, and index investing. 4. Value investing involves looking for undervalued stocks that have the potential to increase in value. Growth investing involves investing in stocks that have the potential for strong earnings growth. Index investing involves investing in a diversified portfolio of stocks that track a particular stock market index. Determine your risk tolerance. 5. Your risk tolerance is the amount of risk you are willing to take on when investing in stocks. This can depend on your age, financial goals, and overall financial situation. If you are young and have a long-term investment horizon, you may be able to take on more risk than someone who is close to retirement. 6. If you have a low risk tolerance, you may want to consider investing in low-risk stocks, such as dividend-paying stocks or blue-chip stocks. If you have a high risk tolerance, you may want to consider investing in high-growth stocks or small-cap stocks. Choose an online brokerage. 7. Once you have developed an investment strategy and determined your risk tolerance, you need to choose an online brokerage. An online brokerage is a platform that allows you to buy and sell stocks online. There are many different online brokerages to choose from, each with its own fees and features. 8. When choosing an online brokerage, you should consider the fees, investment options, and user experience. Open a brokerage account. 9. Once you have chosen an online brokerage, you need to open a brokerage account. This will allow you to buy and sell stocks through the brokerage platform. To open a brokerage account, you will need to provide personal information, such as your name, address, and social security number. 10. You may also need to provide financial information, such as your income and net worth. Once your account is approved, you can fund your account and start buying stocks. Fund your account. 11. Before you can start investing in stocks, you need to fund your brokerage account. This can be done through a bank transfer or by depositing a check. Once your account is funded, you can start buying and selling stocks. Research stocks. 12. Before you invest in a stock, it's important to research the company and its financials. You should look at the company's earnings, revenue, and debt. You should also consider the company's competitive position in its industry and any potential risks or challenges it may face. Risks. 1. Market risk. The stock market can be volatile and unpredictable, and changes in the market can cause the value of your investments to rise or fall rapidly. 2. Company-specific risk. The performance of a company's stock is closely tied to its financial health, so investing in a single company's stock can be risky if the company experiences financial troubles. 3. Political and economic risk. Political and economic factors such as changes in government policies, trade disputes, or natural disasters can affect the stock market and cause fluctuations in stock prices. 4. Liquidity risk. Stocks can be difficult to sell quickly if there are no buyers, which can result in a loss if you need to sell your shares quickly. Rewards. 1. Capital gains. One of the primary benefits of investing in stocks is the potential to earn capital gains, which is the profit you make when you sell a stock at a higher price than you paid for it. 2. Dividends. Many companies pay out dividends to their shareholders, which can provide a steady source of income for investors. 3. Diversification. Investing in a variety of stocks can help to spread out your risk and reduce the impact of individual company or market fluctuations. 4. Long-term growth potential. Historically, the stock market has provided long-term growth and outperformed other types of investments such as bonds or savings accounts. In summary, investing in stocks can be a high-risk, high-reward proposition. While there are risks associated with investing in stocks, the potential for long-term growth and capital gains can make it a worthwhile investment for many investors. However, it's important to do your research and understand the risks involved before making any investment decisions.